What if the tax strategy your CPA never mentioned could legally turn a $100,000 investment into $210,000 tax savings and generate cash flow at the same time? If that sounds too good to be true, stick around, because by the end of this episode, you're going to see exactly how it works. Welcome back to the Vital Wealth Strategies podcast. I'm your host, Patrick Lonergan, and today we're diving deep into one of the most powerful conversations we've had on this show. I brought back a fan favorite, Michael Moffa of Prosperity Tax Advisors, for round two. If you caught his first appearance, we dove into tax strategy and asset protection. You already know Michael doesn't do surface level. Today, we're going even deeper into advanced tax strategies that the top earners in this country are quietly executing right now. Here's the big idea. Most entrepreneurs are stuck in reactive, compliance-based accounting, filing what happened last year instead of engineering what happens next year. Michael and his team flip that script entirely. We're talking about strategies that check every IRS box, survive an audit, and still produce the kind of tax savings that feel almost unfair. Almost. Before we jump in, if you want to get ahead of the game right now, head over to vitalwealth.com/resources. We've built out a vault of tools, guides, and frameworks around tax strategy and wealth building specifically designed for entrepreneurs like you. That's vitalwealth.com/resources. And hey, if this podcast has given you one idea that changed the way you think about money, take 30 seconds and leave us a review. It genuinely helps us reach more entrepreneurs who need to hear this message. All right, Michael, welcome back to the show. Let's get into it. I'm excited about our episode today. We've got Michael Moffa back on the show. We had Michael on a few months ago to talk through some advanced tax strategies, and we thought, well, let's really dig into some of the details. And so we decided to bring Michael back. Michael, thank you so much for joining us here today.
You are welcome. I appreciate the opportunity to come back.
Yeah. So I think about the entrepreneur that's making very healthy income, and they are frustrated by their tax liability. They're overpaying on taxes, relying on reactive instead of proactive strategy. It's compliance-based accounting instead of something that's like looking forward, going, hey, instead of recording the things that happened last year, let's start looking for opportunities where we can start changing the impact of the tax other than just getting the right numbers in the right boxes. And then they're frustrated. They feel like there's uncertainty, possibly skeptical about what's actually legitimate tax strategy out there. Is some of this too good to be true? And then finally, entrepreneurs, they take risks in their business. They shouldn't be penalized by a system they don't fully understand that's taking 30, 40, 50% of their income on the upper end. So I'm looking forward to digging into some of these opportunities today. So Michael, can you just refresh us? Can you give us a little bit of your background, tell us a little bit about your firm, and then we'll get into some of the details.
Yes, absolutely. Appreciate the opportunity again, Pat. So a little bit about my background. I've been a private wealth advisor, licensed securities for almost 25 years now. I started just about towards the end of 2002. And through those years and through many different designations that were acquired, I realized we've been doing both private wealth management and strategic tax planning. And then working with my own CPA just about 15 years ago, getting the same type of responses that I'm sure all of you are receiving from your existing CPA or accountant is, what else is there out there to reduce my taxable income? And I always got the same sort of answers and responses from them. And that is, maybe go out and purchase a vehicle over 6,000 pounds. Maybe it's, doing a home office deduction. Maybe it's contributing to an IRA for pre-tax or a solo 401k if you're a business owner, or any sort of defined contribution plan where you can, such as a pension plan, a SEP IRA, things like that. So very basic, advice from a typical CPA. And so then I knew there were more out there. So I did a little bit of research, a lot more due diligence, and come to find out that there are lots and lots of strategies that the higher net worth, upper echelon, I don't want to say the top 1 or 4%, but the upper echelon that are using and executing on to reduce their taxable income, which drives down their tax exposure. And so doing this, I'm like, well, let's go through and start executing for myself as the example. And put together a team and started doing tax planning right around that decade or so ago. And then here we are, formed Prosperity Tax Advisors. We are the first and only tax advisory firm that houses almost 8 different credentials under one roof. Let me explain real quickly what that is. We have CFPs, we have our CPAs are also IRS enrolled agents. They're also certified financial planners. They're also certified exit planning advisors. We have certified crypto experts. We have accredited wealth management. We have accredited investment fiduciaries. We have about 8 different designations all under one roof. Why is that important for everybody? Because we can provide solid advice around 3 different areas that a typical business owner will go through in their life. Right? They're going to need strategic tax planning to reduce their tax exposure. Obviously, wealth management advice around what to do with the excess money that they're saving versus cutting that check to the IRS. And most importantly, in the future, they're going to have some sort of liquidity event, right? From selling that business or exiting that business. So we can provide true advice in those areas to a business owner, but then we layer on top additional stuff from an estate planning aspect of it, from an asset protection, entity structure aspect of it, making sure that what you have saved so far in your passive assets, you protect them from an inside-outside liability exposure.
Yeah. Yeah. And if people want more information, they should go back and listen to our last episode with Michael on asset protection, because that was, it was really good. We started looking at all the different angles that were exposed to liability, and Michael did a great job covering that. So I'm looking forward to talking about, some of these strategies that you're executing with some of some of the top earners in the country. Okay. And so I want to, this might sound a little silly. I'd like to start at the basics and understand truly what a tax deduction is, kind of define that. So I think it has 2 components. When we start looking at the IRS guidelines for what qualifies as a tax deduction, it needs to be an ordinary expense and it needs to be necessary. And so I don't know if we can get into exactly what it means to have an ordinary expense in the course of business, but I think it'd be good to just get clear on what these two sort of terms mean in regards to the IRS eyes when they're looking at these things.
Absolutely, and it's great to get some very first level knowledge or basic knowledge of what expenses is. So essentially under Internal Revenue Code 162A, and there are a bunch of subsections behind some of these IRC codes. I won't go deep into the lettering of that, but I'll just start very basic from there. The first thing is typically ordinary expense, right? So in order for an expense to be classified as a qualifying business deduction, it's got to meet ordinary and necessary expenses that are paid or incurred right through a taxable year in carrying on any trade or business. So we'll start with ordinary first. So it's basically just something that's common and accepted in your trade or industry, right? Doesn't mean habitual to you, but it means normal for someone in your line of work. Let me give you an example, right? So let's call it a real estate agent. Typically, I know real estate agents, they typically buy gifts for their clients, right? So that is normal and ordinary in that sector or in that industry. Let's say the real estate agent is buying a racehorse, right? And wants to try and deduct that 60, 70, 80, $90,000 expense. Well, that's not going to be ordinary because it's not what's normal in their trade or business, right? So that's just a good example there from the ordinary expense that can be qualifying business deduction, right? Then there's necessary. So necessary is something that's helpful and appropriate for business, right? So it kind of sets the bar a little lower. It does not mean indispensable. So let me give you another example, right? So let's say a continuing, all right, so you and me, Pat, we have to do continuing education courses, right? So the continuing education course doesn't have to be required to be necessary, right? It just has to help you do your job better. So as long as it helps with that trade or business, right, that's the necessary component. And then from an ordinary side, it's got to be something that's used in your business as well as everyone else kind of using the same stuff. So hopefully that's a helpful way to kind of explain very low level the 2 differences.
No, I think that's great. And we can think about like, my marketing spend. Okay. Just about every business has marketing spend, right? And I would say that's generally ordinary and necessary, but I think we also need to be like, there's a lot of latitude in that. The IRS isn't giving me any guidelines on how much money I spend on marketing. If I want to go crazy and go broke spending money on marketing, they're fine with that. And I get a tax deduction. If I want to spend $0 on marketing and also probably go broke, that's also fine.
Mhm.
So
Oh,
there's
let me add one more
yep.
component to that.
Yeah.
Great question there as well. Is that it also has to be reasonable in amount, right? So,
Mm-hmm.
a lot of time that's the third piece that gets
Yeah.
overlooked, right? So, in other words, a business expense can be, let's say, use marketing as it can be
Mm-hmm.
ordinary and it can be necessary to your business, but it can also be disallowed if the
Yeah.
amount is unreasonable. So
Yeah.
where a lot of people run into trouble with this is, again, the IRS is going to look at, let's say, financial advisors or tax
Yep.
advisors. They're going to look at all tax advisors, right? And they're going to look at all financial advisors. What is that average amount that's reasonable
Mm-hmm.
on a ratio basis, right?
Yeah.
So
Yeah.
that it's not disallowed. And where people run into problem is their salaries, right? And
Mm-hmm.
typically rent payments get scrutinized the
Mm.
most in that
Yeah.
area.
Yeah, this is great. And we've also seen this, now that you bring this up, when we look at, we'll call it a micro captive or captive insurance, and it's something that needs to be done really well. If you're not aware, you can Google captive insurance, and you'll find that it's on the IRS 30 dozen list. So it's like, okay, if you're going to execute on that strategy, you need to be mindful of who your third party administrator is putting that into play. But one of the factors there is how much money am I spending on insurance premiums? Because if I'm spending 30% of my revenue on insurance, the IRS is going to look at that and go, maybe that's unreasonable. That number might be too high for a business to spend. And I think that just drives home your point there.
Well,
Same thing with salaries
let
and
me add
rents. So
one more
yeah.
to that too, right? So not
Mm-hmm.
only is it looking at it from a 30% ratio of insurance premiums, but are
Mm-hmm.
the policies that you're selecting inside the micro cap or the 831B
Yep.
appropriate and necessary to your trade or business? Let me give you an example. So I love captives. If they're done
Mm-hmm.
correctly, they are a very powerful tax strategy where you
Agree.
can put money away, get a deduction up front, still hold on to those assets, and then reinvest them in the stock market, maybe some private credit, equity, or lending funds or instruments. And then after 12 months, as long as there's no claims against that policy or those policies, you have full access to that money after 12 months from a liquidity standpoint. And then if you take a withdrawal, it's only capital gains. So you save ordinary income up front, no claims throughout the year, plus you could invest it in the market, get a little
Yep.
growth, and then it'd be cap gain upon withdrawal. But if you have a policy that you're paying a premium on and it doesn't apply to your business, example, we had a client that is in the ticket business, and they bought, somehow they would go and buy almost $2 million worth of cell phones. And when oh my God, I'm having what is
Like
the blonde?
Ticketmaster,
No, it's
Taylor Swift. Taylor
Taylor
Swift.
Swift. There you go. There you go. So
Yeah.
Taylor
Yeah.
Swift would come into it for a concert, right? They would get access to these VIP tickets at like $300-400. Then they would sell them, turn around and sell them for like $5, 10, $15,000, right? Huge markup in there. But when he did his captive, he came to us. He didn't. We didn't do it his captive. He had another team do it, and they did it
Mm-hmm.
incorrectly. So when we did an audit on that, we found that he was, one of his policies was accounts receivable. Right, he was paying a premium to that policy.
Yeah.
Well, when we did a deeper dive, he doesn't have any AR
Yeah.
accounts. Right, he had no accounts receivables. So in other words, he's paying for something that was not ordinary and necessary to his trade, which tends to
Yep.
fall into the side where the IRS will scrutinize that, and then that's how you get yourself in trouble. So it's got
Yeah.
to. There are right strategies out there for everything. You
Yeah.
just got to be able to execute the architecture correctly.
Yeah. I love it. I love it. Now I'd like to talk about another, I'll say test if that's the right term, but
Yep.
economic substance. Just thinking about how economic substance comes into play with the IRS and how they look at some of these these structures that get put into play. So can you help us define what economic substance is when it comes to tax strategy?
Yeah, absolutely. So this is also can get into the weeds. So I'm going to try and
Mm-hmm.
stay
Yeah, good.
10,000 feet high. But there is something that's called economic substance. Again, it's another IRC or Internal Revenue Code 7701 O. And basically what this is that what they're looking for is a two-pronged test, right? And both have to be satisfied. So on a very high level,
Mm-hmm.
let's say the first prong is objective. So does the transaction meaningfully change the taxpayer's economic position apart from the tax savings or the tax effect, right? So what
Yep.
does that mean? If you just take out the tax savings, right?
Mm-hmm.
Are you actually different, right? Financially, operationally, than you were
Yep.
before? So let me give
Mm-hmm.
you a couple examples what would pass and then obviously what would fail, right? So buying a rental property, right? So this is what would pass part one of the prong, right? Buying a
Mm-hmm.
rental property. So let's say your balance sheet has an asset, has a liability, right? You have rental
Yep.
income. Obviously, there's repair obligations. I know this from owning 4 different short-term rental properties. That's
Yeah.
wonderful. And then there's tenant risk, right? So there's substance there from an objectivity
Mm-hmm.
standpoint, which passes. Now,
Yep.
if it fails, here's another example of what that is. If it's just paper that moves through 5 entities, and then you end up
Mm-hmm.
where you started, except with no deduction. So, example is you
Yeah.
have this shell company, that shell company, this one here, and you're just passing the documents or agreements in place, but nothing changed. You don't have any risk,
Yep.
right? You're not receiving income. You're not there's no maybe client or patient risk to that, right? So
Mm-hmm.
if it's just moving something around, that's an
Yep.
automatic failure under prong one. Now,
Sure.
prong two is what does they call it? Subjective, right? So
Yeah.
this is where substantial non-tax purpose entering what the transaction would be entailed for.
Mm-hmm.
So examples, tax savings can be a reason, right?
Yep.
But it can't be the only reason.
Right.
So an example would be, and we do this a lot for a lot of clients that come in, they just have like an LLC or not even an LLC. So one of the
Mm-hmm.
tax strategies could be implementing an S corporation election if they make
Yeah.
enough income from a net profit standpoint. But forming an S corp is liability protection, enterprise value. There's even succession planning and self-employment tax savings. So the first
Mm-hmm.
three are substantial non-tax purposes. So that's like an example from a subjective prong two, right? That would qualify under economic substance. Now, I'm going to give you guys an idea of an example that does not apply and crosses the line, right? So you've
Yep.
heard me say this before with syndicated conservation easements, right?
Yep.
So, promoters, what happens with conservation easements, they're typically leveraged from from two all the way to like I've seen ones many years ago, 10 to 1, right? So every
Mm-hmm.
dollar you put in, you get a $10 donation or deduction, right?
Yep.
So what happens is that a lot of the promoters have these sort of high leverages inside, and they usually get shut down by IRS tax court. And the reason for that is because they don't have the fair market value appraisal there, right? So there's no
Yep.
substance there, and it's they're selling it at a high donation because they want the highest deduction possible, right? So those
Yep.
are some examples. There's that, obviously
Yeah.
the 831 that I explained
Yeah.
before too.
Yeah, yeah, this is great. And so I want to create some parallels and sort of look at the economic substance of one and how it's missing in the other. And you brought up both of these examples, but I think it'll be good to stack them side by side. So the first one is real estate. Okay, let's think about real estate for a second. Let's say I'm really good at negotiating owner finance deals, okay? And I go find a motivated seller that is interested in moving on from their house. And I'm like, cool, this is going to be a great short-term rental for me. And so I structure a deal where I put $5,000 down, okay? Ridiculously low amount on a $500,000 property, okay? And the seller's willing to take payments over time. And so when I think about that $500,000 property, the cool thing about the big beautiful bill and the tax code is it allows me to do a cost segregation study and accelerate all of that depreciation in that property. Let's just use for round numbers 30% of that property is is now
Depreciable.
tax deductible, right? Yep. I can depreciate that and deduct it. So that gives me $150,000 deduction on my $5,000 investment. Okay, fantastic leverage there.
Oh yeah.
Now I still have to go execute the deal, make it cash flow. Hopefully it appreciates because of all the good work I'm doing and the market conditions, and I'm getting loan amortization and all that fun stuff, right? So we can see in that example some tremendous tax benefit for a very low dollar investment. And then on the other side, you're talking about the conservation easements. We saw leverage applied there too. And let's say I put in, $100,000 and they gave me $1 million deduction. But the only thing I'm doing there is generating a tax loss, right? Like there's no, and because of the syndication, because of the way it was organized, the IRS started looking at those going, nope, we don't like the way this is put together. The only reason this is happening is for tax benefit, not any economic benefit to society. So I think those two examples are great examples of like, yep, this one has economic substance, this other one doesn't. So I appreciate that example. So now, if it's okay, unless you have anything to add there, I'd like to get into some different examples you've seen in practice that start to meet all these definitions: ordinary, necessary, has economic substance, and just see how they work out.
Yeah, absolutely. Yeah, let's go.
All right, good. So I think we've talked through a few sort of offline before, and you've got some just fascinating strategies. And I sort of ran you through the ringer on understanding some of these, because I think it's important. Like sometimes, if we go back to my real estate example where I put $5,000 down and I get $150,000 deduction, like that sounds too good to be true, but it's totally legitimate. And so I want to talk through some opportunities that you think are really unique. I think there's some in the healthcare space that sort of fit some of these definitions. We can start to unpack those a little bit, see how they work, and then see what the economic benefit is, and then also the tax deduction side.
Absolutely. So I appreciate the layup on that. So one of our advanced tax strategies, again, a lot of clients have to qualify for each of these things. That's why when we have a prospective lead come in to our firm, we always do what we call a sort of a forensic or tax analysis up front, right? We got to look through the client's details, their tax returns and everything of such. And then as we run through our tax team and we look at which strategies they would qualify for, and then select the ones they should be doing, right? There are plenty of strategies they could do, but we identified the ones they should be doing, right?
Yeah.
And so one of them, which I'll share here today.
Can I stop you for just a second? Because I think that is such an important thing. Like we have clients that will come to us and they'll be like, hey, I heard about short-term rentals. Those sound amazing. I'm ready to like get my tax bill like down to zero, and I'm going to just buy short-term rentals. I'm like, okay, cool. Are you ready to be in the real estate business? And they're like, what do you mean? And I'm like, well, we've got to figure out how to execute on those short-term rentals. Like every time we buy a piece of real estate, it's like running a small business. And unless we have the systems and processes in place to make that go, you should probably look for other tax strategies. So I think understanding a client's goals and objectives and their capacities is awfully important for designing a tax strategy. So I appreciate you highlighting that. And I think it's easy to go out there and read something on Reddit and be like, that's my new strategy. And it's like, no, go talk to a professional, make sure they understand your situation, both from a financial point of view, like maybe something applies, maybe it doesn't. And also from just a goals in life perspective, and make sure that the tax strategy aligns with all those. So sorry to interrupt you, but I thought that was an important point.
Yeah, no, absolutely. One of our, so let me go into one of our tax strategies. Again, if the client qualifies after us doing like a thorough analysis, but typically we kind of tee it up this way. So we say, have you ever heard of a high net worth investors that typically back healthcare technology companies and use that as a tax vehicle? So imagine a healthcare technology company that builds clinical software, the kind that hospitals and provider networks license to run their operations, right? So you as the taxpayer invest in the company and the software it owns. Now, because the software is a real depreciable asset, right, you get to write a very large portion of it down against your income in the current year. Then on the other side, right, the same company pays you an ongoing licensing fee for the software you helped fund. And so you're not just taking a deduction, you're also picking up an income stream that runs for
Nice.
years, right? So
Yeah.
now, knowing that on hand, I'm going to go through where it sort of qualifies in ordinary, necessary, right,
Yep.
economic
Yep.
substance, and go down the list, right? So
Great.
the stack code essentially is under 162, which is active trade or business, right? So there's an operating agreement that specifically establishes this as a active trade business, meaning that it's not just a passive investment vehicle. Okay, so it checks that
Yep.
box off. Then you have 179 and 168 of the code, which is the depreciation parts of the code, right? And so you could do immediate expensing of any qualifying computer software used in active or trade of a business, right? And then you have the 168 side, which is the bonus depreciation. You could do either one or both, depending on how large the software purchase is, right? So that checks those boxes off under the depreciation side of the code. Then we get to the risk side, right? So under 465 of the code, you have what's called, do you have active risk in this sort of strategy? And you do, because there's a non-callable recourse note. Now, what this note does is it gives you a higher leverage, a 7-to-1. And all the leverage does, and it's called creative financing, so sort of self-financing, like the example you use with the real estate side, a seller financing deal, right? It's 7-to-1. You get the highest tax impact with the least amount of cash out of your pocket to fund this investment strategy, right? So under 465 checks off as well. Why? Because there's a recourse note that creates at-risk basis, right? So, and with the personal guaranteed and the non-callable side. So bam, that checks that off. Well, now we work down to the IRC code stack, right? So 469 of the code. Well, this is the material participation. Now, all our tax strategies are real companies that you're investing in, maybe not from an equity standpoint, but from a depreciation standpoint, right? Now, you also have to complete the 100-hour test typically throughout the year to make sure you're participating in that business. We require our clients to spend just 2 hours a week, right? You do that every 4 weeks. There's your close to 100 hours per year. And that's all tracked through marketing activity, audio content. There are devices linked up to your Apple Watch for this particular healthcare strategy, right? So that checks that box under 469, meaning material participation. Let's get to the economic substance side. So both prongs of the test is checked off as well, and here's why. Because is it ordinary? Well, you're acquiring software licenses for a productive business is one of the most common transactions in modern economy, right? Is it necessary? Yes, the software is a productive asset. It generates revenue through the doctor using the software to monitor their patients and billing Medicare, Medicaid, and private insurance. Check that box off under necessary economic substance. Is it reasonable? Well, the pricing supported by a third party, Adams Capital, right? They did a third party valuation on this company and found this company to be worth $220 million. Okay, reasonable. Check. Right now, is it active trade or business? The last part of this, and between the operating agreements, the right to use agreements, the 100-hour participation establishes it as a active trade or business, not a passive investment. So it checks all of these IRC code stacks. And again, it makes what we do defensible, right? And yes, if an IRS agent ever has a random audit or a random question about our strategies, we defend them.
Right. Yep. Yeah. And I think that's important to highlight. So first, I think the documentation, all of the things you just highlighted, the third party appraisals that are saying, hey, look, we have no vested interest in this organization. Here's what our opinion of the value is. I think that's important. We see that all the time in discounting we do for clients, estate planning, all of those factors. It's so good. And then, when the IRS does show up, because from time to time they do, it's random. They also have more sophisticated technology around, AI starting to look at tax returns and that type of thing, which is awfully interesting. The thing I appreciate about what you guys are doing at Prosperity Tax Advisors is you'll stand behind it and audit. If an audit shows up, you're like, here we go. We'll make sure that we're defending this to support the strategy. I think that's a critical piece. Real quick, we went deep on some pretty advanced tax territory, and I want to know what's on your mind. What's coming up for you? Maybe you heard something today that made you think, wait, I need to know more about that. Or maybe you've got a completely different question about tax strategy, wealth building, or protecting what you've worked so hard to build. Either way, I want to hear it. Head over to vitalwealth.com/questions and drop it right there. We're actively pulling from these submissions to shape future episodes and bring in the right experts to give you real answers, not generic advice. The questions we're seeing are building our guest list. So if something is on your mind, chances are it's on someone else's mind too. That's vitalwealth.com/questions. Go ask it. You might just hear your question answered on a future episode. All right, back to Michael. Michael, can we just sort of summarize the economic benefits here? Because I think you're totally right. When I think about some of the opportunities out there, I think about an oil and gas investment, for example. I get significant tax benefits, but I also get significant cash flow. And it's like you start marrying those two things together, and that can be for the right person a really cool way to allocate dollars. And so I don't think it's any different here on the software side. But I think it'd be good to just kind of recap, like, okay, here's the asset I'm buying. Here's we've already talked about some of the cash flow, but it'd be good to understand, like, the dollars I'm putting in, the tax deduction that it's generating, and how much that's really translating into economic value for me.
Yeah. So one of the examples, because a lot of people recommend oil and gas. I think it's a good investment. I think it's great to diversify out, and that's more. I say more on the conservative side, but it's got real risk to it, right? And the reason you get the deductions, I'm going to show you a side-by-side example from a number standpoint, but against one of our advanced tax strategies, and we have over 24 of them that we can qualify certain clients to mitigate their tax exposure. But let's just look at oil and gas, and we're just going to use a $100,000 investment as the example. So depending on the type of exploratory funds that you look at from an oil and gas side, some have more oil, less, and some gas. Some actually go out and explore to drill more gas and a little bit of oil, or a combination of both. But from a tax standpoint, an investment standpoint, or all-in cost standpoint, you do $100,000 into oil and gas. You get an 80% deduction typically on some of the tangible stuff, or some of the equipment, right, that's being used. The reason you're able to get that deduction is because on the K1 you are a general partnership, right? There are two types of partnerships. There's general, which gets to be able to participate in some of the business expenses and deductions. Or you're a limited partnership, an LP, which you do not get to partake in some of the expenses and business deductions. You're just a private silent investor. LP, general partner, you're all in, right? So another example of that would be if there is a exploratory crisis or challenge, meaning a rig blew up somewhere, you be prepared that now as the insurances are covered based on the oil and gas companies, you could still be liable to a lawsuit from that sort of transaction. So keep that in mind. But from a number standpoint, you put $100,000 in, you get an 80% deduction, so an $80,000 deduction, and I'm just going to stay at 30% tax rate. That's a $24,000 tax mitigation, right? So in other words, tax savings. You receive that off of your tax bill. Okay. Now, let me use the healthcare as the same example, right? And so again, in the healthcare technology strategy, you're buying software that's used in doctors' offices. They use the AI software to monitor their patients at home from a critical chronic care disease management side. If they got hypertension, COPD, diabetes, heart failure, right? They got to monitor those patients and their vitals at home, and that goes up into the software. So same scenario, you fund $100,000 in our healthcare fund. You'll actually get a 7-to-1 leverage. You'll get a $700,000 $100,000 deduction, not an $80,000
Yeah.
deduction, right? Then there is a non-callable recourse note that you pay interest only on. Okay, again, it's not running your credit, it's not running your Social Security
Yep.
number. At the
Hmm.
same 30% level, you're getting a $210,000 savings, tax
Yep.
savings. Same 100,000 on oil and gas, you're getting 24,000, right? So big
Yeah.
difference there. Now, you get 6% cash flow and a 1.5x multiple down the line if the healthcare technology firm sells and has a liquidity event to a private equity group, right? So you get
Yeah.
some of that capital back. But the reason you get the 6% cash flow is because they're selling you the right to use for the license copies back to them so they could go out and assign one license copy to one patient on the
Hmm.
platform, right? And they pay you a
Yep.
revenue stream, which covers your interest only note, and then you
Yeah.
benefit 6% from that.
I love it. Yeah, and I think it's just good to keep in mind the benefit of the leverage. You know, it's fantastic. It also has the cash flow to support the debt, which I think is important. Is there scenarios where I could put the money into this and then all of a sudden I've got a possibility where the software, the user base isn't there, and the note, is a problem for me? I know we just talked about it's not.
Yeah,
It doesn't sound like it's recourse, but yeah, I'm
absolutely.
curious how
So,
it
so,
plays out.
so I'll spend just a few minutes on sort of the black swan
Yeah,
hypothetical crystal ball
yeah,
effect down the road,
yep,
right?
sure.
So, or speculative way, but it's important to know that we've already thought about these exit sort of vehicles along the way with any
Hmm.
of our tax strategies, right? Again, we do the implementation, the documentation, the substantiation, and the audit protection around that. That's from an IRS perspective, but we're also looking at it from a what if a business goes bankrupt? What if another strategy
Yep.
we have doesn't collect any revenue or enough revenue coming in from the front end, right? So
Hmm.
for everybody's understanding, these are advanced strategies, but they're very simplified the way we explain it, okay? Because we're the
Hmm.
experts in this field.
Yep.
You're mitigating your tax bill today. You're driving that exposure down to zero. But at some point, you're deferring it out many, 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 many years, and
Yep.
it comes back in the form of a recapture on the note when it gets paid off. At that
Hmm.
point in the late future, it becomes a taxable event, but we can convert that into a potential capital gain event. So
Sure.
essentially, taking ordinary income today, mitigating it to zero, deferring that out 5, 6, 7, 10, sometimes even 15 years, right?
Right.
And then converting it to a cap gain event at that point in time in the future, and then rolling it into either another strategy and then continuing the process. And then at death, you get a sort of a step up basis there for the estate moving forward. Now, what if we have a bankruptcy, right? It's a question we get asked a lot. So we actually model out a workflow chart process of what happens. You have the 6% that's generated from cash flow of the patients being on the platform. There's a liquidity event. Well, what if that doesn't happen in 3, 4, 5 years? Well, we push it to 10 years, and if not, you have an extension for another 10 years out, right? Eventually, they will sell. The company has got 30 years of experience doing liquidity events
Yep.
in the healthcare clinic space, right? But what
Sure.
if, let's say, for whatever reason, they have no debt, but what if they go bankrupt? Well, it's a process that occurs from there on, and we kind of model that out. Example would be it would go to a bankruptcy court, right? Chapter 7, 11, and 13. Again, we're following all of this if
Yep.
speculatively it happens, right? But
Yep.
the
Yep.
judge will make the final decision, and if the judge says, okay, it's a forgivable debt or it's cancellation of debt, it can either become taxable or it cannot become taxable, right? So there are certain variations and steps that need to happen at that point in time under 106 and 108 of the bankruptcy codes, where the cancellation of debt can be exempted from your gross income, right? Or it could be added to your gross income. But we have mechanisms in place to handle that exit or that scenario if and when speculatively it happens in the near future. So we're always thinking proactively, and we have to. That's what makes us stand out from a traditional CPA firm that's looking behind you, right? They're not
Yeah.
even looking forward, let alone if they recommend a strategy. Same thing with oil and gas. If there is a situation that arises from that, is the client prepared to handle a lawsuit from the families that
Right.
they're that died on a rig or something, an explosion, as an example? What
Right.
is that client doing to proactively plan for that? What is that
Hmm.
CPA doing for that client that they recommended them go into a fund that? So like we're already thinking 7, 8, 9 steps ahead if it happens. If it doesn't happen, we're all golden. Client still receives the deduction year one in that
Yeah.
scenario.
Yeah. Yeah. No, this
So
is,
it's a
this,
lot, but
yeah,
it's our
no, no.
process, moving forward.
Yep. Yeah. No, this is fantastic. And I think another thing it's highlighting is, these strategies and opportunities out there. Cause you highlighted this, at the beginning. We want nothing to do with spending a dollar to save 37, 40, 50, 51 cents. That doesn't have anything to do with wealth building. That's terrible tax strategy. I'm fine with you buying a G class. If you're going to buy it anyway, let's optimize the deduction, but just please don't
Correct.
go buy a G class thinking that's like a wise economic move. It just isn't. It might be a fun car to drive. I'm not opposed to the G class, but it's just something to be mindful of. So the thing that I appreciate about the strategies you're talking about is you go out and you scour the marketplace and you're like, oh, here's an interesting investment opportunity. Here's also an interesting opportunity to save the entrepreneur some real tax dollars. And when we marry these two together, it's a beautiful thing. And so I think this just highlights the opportunities that are out there. We like to have these discussions to show people what's possible, because I think unfortunately most people aren't operating in this in a space with creative people like you, and they think the default strategy is the only strategy, and that's I just have to pay the tax. And so
Right.
we think these conversations are awfully important. Michael, if somebody's like, hey, I need more of this in my life, I need to look at some of these opportunities. We're always happy to get people plugged into you, but how should somebody go about finding more about what kind of work you're doing?
Absolutely. So I think the best way would be to reach out to either our business development team,
Mm-hmm.
which would be Sarah Shortridge, right? So
Yep.
S Shortridge at prosperityta.com, and you could probably pass that out too, or
Yep.
maybe put it in the chat.
Yeah. Yeah.
Pat.
We'll
But
put it in the show notes
yeah,
for everybody
perfect.
to
Yeah,
go
so you can
grab.
reach out
So
our
yep.
team that way. You could call us. We're located here in Tampa, Florida. We're
Yep.
actually right by the airport, so like 2 minutes from the airport.
Nice.
Yeah, or send me an email if you have
Yep.
more specific higher end questions, or if you
Sure.
want to test us out on knowledge
Yep.
and expertise. You could reach out to our team, myself.
Yep.
But yeah, you could provide
Sure.
that information. Pretty easy to
Yeah.
get a hold of us.
Yeah, yeah, absolutely. I think I've interacted with Sarah, and she's actually listening along here. But she's
Yes.
incredible, and so we'll have Sarah's contact information in the show notes. There's also some great studies, case studies on your website that I think are worth checking out at prosperityta.com. So we'll make sure all of that is out there.
Hang
And
on,
yeah,
one more thing
please.
to add, Pat. I appreciate the opportunity,
Hmm.
but again, our team is also CPAs certified exit planning
Hmm.
advisor. So if you have a business owner in your network or your base or your clientele that's having a future liquidity event today, next year, or maybe selling a highly appreciated asset that it's a tax,
Yep.
the tax component of that is what we specialize in
Hmm.
mitigating, right? And
Yep.
again, the reason we had these 8 credentials under one roof from a tax advisory standpoint is we could provide that educated
Yep.
advice from a business owner selling either an asset or their business, and we're the
Yep.
first ones to usually go in from a SEPA standpoint from a tax mitigation exposure.
Yeah.
So
Yeah. And here's also another thing that matters. Like the income tax shows up every single year. So do some income tax planning. But if you're planning on exiting, there's a huge difference between a tax strategy that lives in the business that drives down EBITDA that a potential buyer could go, oh, can we add that back? If not, and I'm going to use an example of like a cash balance plan.
mhm.
If I've got a cash balance plan in place and there's employees that are getting benefit from that, the acquiring company is going to go, oh, I see you're putting $10,000 a year in or $50,000 a year in for your employees.
Mhm.
If I'm selling my company at a 10x multiple, they're going to expect to pay that $50,000 moving forward because the employees receive it as a benefit now. So that just cost me $500,000 because I put that cash balance plan in place. I'm not saying don't do a cash balance plan. I'm just saying you just need to be super mindful of how these strategies affect the business bottom line and what an acquiring company is going to look at. And so I think another reason to find good advice, talk to Michael and his team. We're always happy to help, guide through some of these things as well. But it's like, you have to be mindful of, you don't want to be penny wise and pound foolish on any front. And so it might make a lot more sense to put the tax strategy, on the personal side versus through the business and impact and exit down the road.
And just to add on to that, all our tax strategies are on the personal side. We create separately managed Wyoming LLCs as the operating entity, and we utilize the various tax strategies in that entity, so that won't affect your main business EBITDA. So you could keep that high, and whatever your profit you're showing will get offset over here on the personal side, right? So again, thinking forward, right? Most like a cash balance plan and some other stuff they do inside the business. Captives, the micro captives. Again, you're pulling money out of the business to fund a separate insurance policy, right? It's taking money out of the business. How do you keep the money in the business, capture the EBITDA, and then do strategies outside of that profit so that the business stays alone? It can have the highest multiple there. So again, always reach out to us if you have questions about a future liquidity, questions on selling an asset, because there are multiple ways to do it right, and there's a ton of ways that you can do it wrong.
Right. Yeah, no, this is great. And Michael, why don't you tease for just a second? Because I love the Wyoming LLC idea and how does somebody use that? Do they set up like an investment company? Is it a management company? How are they able to like run some of the deductions?
Good. So we do.
Yep, go ahead.
No, get. You can finish that. Sorry.
No, I was just going to say, I want to set up enough of this so people are like, oh, I'm super excited about that, so they can come back and listen to the next episode. Because if we're not careful, we'll talk for another hour.
Yeah. And it could go on longer than that. So, just for the tease side of it, we look at about 7 or 8 different states from an asset protection structure framework, right? And when the words you'll see on our ads and what we put, it was tax engineering and tax architecture, right? So tax architecture, it basically just means you're structuring the right framework to layer the tax strategies on top. If you don't have that foundation set up, right, you can't just layer a strategy on top. It's gonna fall through essentially, right? It's gonna fall apart. It's not gonna work the way you want it to be. So we like to design from an engineering standpoint the layout of the tax strategies and the foundation for every single client, and it's different for every single client. But from a Wyoming standpoint, we like Wyoming. Now, again, we look at Arizona, we look at Nevada, we look at Alaska, we look at Delaware, South Dakota, North Carolina, Wyoming. And the reason we stay with Wyoming, I like it from a privacy statute standpoint and a charging order protection standpoint. The charging order is something that, and it's called COPE, COPE. And I spoke about this the last time on our show, but it's super important to use it as a holding company for passive assets. So in other words, some people have, and Pat, you may run through your client list, and you guys are pretty sophisticated, but sometimes the clients don't move right away. But how many brokerage accounts have more than about $300,000-$400,000 in non-qualified brokerage, right? That's in their name or jointly with rights of survivorship, right? Tons. Now,
easy money.
Easy money from a litigation and creditor standpoint, right? So if somebody slips and falls in your property, get into a car accident, any outside liability risk, you can have all the insurances in the world, but they can also sue you civilly also with the insurances, right? They know they'll get paid from the umbrella policy, they'll get paid from the insurance policy, but they could sue you individually, and you have to defend yourself individually. Now, you got to hire an attorney, but let's say they work their way up. You don't have any of the strategies from an entity optimization standpoint like we recommend. They could come after all your assets. If you own a business, your ownership allocation, they could come after the ownership allocation of your business. In other words, take over your 30, 40, 50, 100% ownership in that business. If you lose, right, going up the ladder. But if you have a Wyoming holding company, and this is for strictly passive assets, and you have that holding company in Wyoming with a COPE language inside the operating agreement, they could only come after the charging order, meaning they could only come after the distribution or withdrawal you take from that Wyoming bank account to your personal bank account. As long as you didn't commit anything fraudulent, criminal, negligent, right? Those three things, they can't pierce that veil, and they never will. And they will never fire sale any assets behind that Wyoming holding company. And they can only come after the distribution. Let's say you have $10,000 of dividends from rental income, supposedly, right? From a rental real estate. They can only come after that $10,000. They can't come after the property. They can't come after your brokerage account that's hidden behind the Wyoming holding company. So, that's just a little tease there. And I know we talked about it last time, but there's so much more to entity optimization from an asset protection standpoint that people need to understand and execute on, and they don't.
Right. I love it. And the execution's the biggest part. People will get documents set up. They'll get the entity set up. We've had clients come to us with a Wyoming LLC and nothing's transferred to it. It's like, I feel like if you don't have somebody in your life, and this is where we feel like the fractional family office structure makes a ton of sense, that can just keep track of all of these things and make sure that they're buttoned up so you can stay focused on the main thing. Things start falling through the cracks, and you're going to end up with more liability. You're going to end up paying more tax, more frustration in general. So,
one more little point. Sorry, there's so many nuggets that again, we'll save it for a future podcast to come to get people to come back. But another thing in the crypto space, a lot of people are starting to get into crypto. They're understanding crypto. They like it. It's a little diversification. It's volatile, but there are a lot of people making a ton of money in crypto. So there are tax strategies we have that we specialize in, and to offset the tax exposure from the cap gain side of the crypto side. And it's not just creating a CRT, like a charitable remainder trust. That's one that a lot of people go to for that. It's great, but there are other incentives and other strategies out there that you don't have to lock the money up in a trust and only be able to get access to 5 or 6% of that profit or that income per year. But we can also go after, because we are certified crypto experts as a credential within our tax advisory house, right? So we have that expertise, and we can also offset that cap gain. We can structure it as ordinary gain, and then we can offset it by another tax strategy and wipe out that tax exposure. So we can always talk more about that. We'll maybe have that as another session maybe in the future. Because I know more people are starting to get into that crypto space, and then they're like, oh man, I have these gains, but their gains are treated differently from a tax standpoint. So, but yeah.
This is great. Michael, we could roll all day long, but here's the reality. Failure to take action, you're going to be overpaying hundreds of thousands, if not millions of dollars in tax over time. And we don't want that. We feel like the entrepreneur is the backbone of our economy. They drive this nation forward. Let's keep more dollars in their hands versus send it off to the IRS. Also, if we're sort of doing these things on our own, we've just got this increased audit risk from poorly structured strategies. Work with professionals that know what they're doing, and then your wealth's not going to grow. You're either spending $1 to save 37 cents in tax, or you're just giving it to the IRS. Neither one is any good. So find somebody that can help you build wealth with your tax strategy, and then you're legally minimizing your taxes when you execute these things well. You're creating clarity and confidence, especially when you've got a firm that's willing to stand behind you and support you if the IRS ever comes and wants to look closely. And you're accelerating your wealth, accumulating and your wealth accumulation, and you're building legacy, which I think is awesome. So Michael, thank you so much for joining us here today. I do appreciate it, and we'll almost certainly find another time to have you back on the show.
Awesome. Well, Pat, appreciate it. Thank you for the opportunity.
All right. Thanks, everybody.
All right. Thank you. Bye.
That's a wrap on another incredible episode of the Vital Wealth Strategies podcast. Michael, thank you for coming back and dropping so much value. This one is going to stick with a lot of people for a long time. To everyone listening, I genuinely hope you walked away from this conversation with at least one idea that changes the way you think about your tax strategy. If you did, do me a favor. Don't keep it to yourself. Share this episode with a fellow entrepreneur, a business owner, a friend who is overpaying the IRS right now. One conversation, one episode can be the thing that shifts everything for them. And if you're ready to take action on what you heard today, your next step is simple. Go to vitalwealth.com/resources. We've put together a vault of tools and frameworks specifically built for entrepreneurs. who are serious about minimizing taxes and building real wealth. Everything you need to get started is right there at vitalwealth.com/resources. If this episode brought you value, please take a moment to leave us a review. It means the world to us, and it helps this podcast reach more entrepreneurs who need to hear these conversations. We read every single one and are deeply grateful for your support. And remember, you're a vital entrepreneur. You're vital because you're the backbone of our economy, creating opportunities, driving growth, and making an impact. You're vital to your family, creating abundance in every aspect of life. And you're vital to me because you're committed to growing your wealth, leading with purpose, and creating something truly great. Thank you for being a part of this incredible community of vital entrepreneurs. I appreciate you. I look forward to having you back here next time on the Vital Wealth Strategies podcast, where we help entrepreneurs minimize their taxes, master wealth, and optimize their lives.